All right. Good morning. Good morning, everybody. Hey, Mr. E, Happy New Year. So a little red around the world. Hong Kong down the most. No subtle stimulus out of them this morning at minus 1.7%. Small caps down 1% with the IWF IWD ratio getting that big breakdown yesterday. Growth versus value was instead just, yes, it wasn't one, which one is better, which one is worse. It's both. But it was a big breakdown. And small caps are certainly reflecting that this morning. NASDAQ, a little more than 0.5%, S&P less than 0.5%, and the Dow doing the best this morning. Blue chip companies only down 0.25%. It's jobs week. The data that we're going to get throughout the week is going to reinforce the idea of all these rate cuts that have been pulled forward. And if we start to see the markets unwind this a little bit, we're going to go down some. It's not like we're talking about, revisiting some major lows or anything like that. That's really off the table. There was a conversation last week about big sell-offs, and really it would take an economic catastrophe to cause something like that. A COVID style event, right? Or like the financial banking crisis, something huge at this point is what would be required to actually put us in that sort of a tailspin. The January 31st FOMC meeting really isn't the one in focus. It's the one after that, right? From March forward, they've started pricing in these rate cuts. Right now, well, as we came into the new year, they had 150 rate cuts priced in, 150 points of rate. So if they start to unwind that, then we're going to go down some. And their choice for doing that is going to come from the data that we get, starting with these job numbers this week. I do think if we start to see them unwind, they'll do something for the March, May, or June. I don't really think you need to watch too heavy on the later four. It's not to say you should ignore them. Just if you're looking for those changes, I would focus most of my attention on March, May, maybe June. So we got Barkin speaking today, and then of course job numbers. The minutes come out today. This always confuses newer traders. It is the FOMC minutes, not the FOMC meeting. And they've gotten better. I mean, we get these minutes a lot sooner than we used to get them. They are cold, so they go through and decide what's going to be in the minutes. They shift through the material and they publish exactly what they want to publish. But this is going to give some depth to the dot plot. It's going to give some idea about who voted for what and what their discussion was about the upcoming meetings. So these minutes do provide clarity to the market and can cause sell-off, run to the upside. The market has been just ripping since Powell. And, he's not necessarily eloquent when it comes to trying to get the message across. So this is going to clarify things and put it into hard writing. And there won't be a way to kind of peek between the lines and try to see some hidden message in there. Jolts at 10 a.m. Remember Jolts? is how easy you think it will be to find a new job if you were to leave or quit or get fired from the job that you have now, basically. Easiest way to remember JOLTS, take this job and shove it. So ISM manufacturing is also at 10. And we're going to get some data out of Japan tonight. Shouldn't be too bad, all things considered, but right now Japan is the biggest unknown. So always want to keep your eye on anything that's coming out of Japan. We're starting to see a little bit of unwind from all the exuberance with the Bitcoin and Bitcoin proxies. The decision is supposed to come in by the 10th, but we're already starting to see some leanings of which way they're going to go. And we might very likely get the answer to the ruling before the 10th, even though it might not be official until the 10th. But that whole run up plus 20% move, all through December, was predicated on the idea that this ETF was going to pass. And if it doesn't, it should be a considerably violent move. If you're trading futures, there's Bitcoin mini, micro, and nano, like super, super small Bitcoin futures that you can trade. Each point, or excuse me, each tick is going to risk a nickel. I mean, you can't get risk smaller than that, right? Especially in the futures, a nickel. That wouldn't even cover the tax on your coffee at the coffee shop. So smallest risk you could imagine. So 10 o'clock and 2 o'clock are the time frames today to really keep your eye on. Watch the clock, right? All right, you can see we're through the 0 gamma level. We're underneath the volatility trigger. The put wall is all the way down at the 10-week still. So, there's no help from that anytime soon. To get there, we would have to pass through the 20-day moving average, both of the ADR half and ADR full. We'd have to break through all these different voodoo levels. It's very likely that we won't go that far today. It's possible that we could, but it's very unlikely. Right? We'd very likely trigger lock limits first before we'd get down there. We're now firmly underneath the 10-day moving average. So we have crossed underneath that, buzzbeat against the bottom of it and expanded to the downside. We're underneath last week's low. And so far we have a missed daily pivot. There's no market maker move here yet this morning, so they're not hedging. It is worth taking a look at yesterday's low. It's the next pivot that we're coming up with. Just keep in mind this double bottom, like all double bottoms, are a bear trap. So we could break down and not present a double bottom and just continue going to the downside. Or we could break down through this level, turn around and come back up. It's a bear trap. It's supposed to be convincing to bears so that they'll get in and try to take a short. So it needs to come down enough to convince those bears that we're really going down and to get in. When I was newer to trading, I thought it was supposed to bounce on the pivot and go. And I could find old examples of where price had come down and hit a pivot perfectly and bounced and went. And I thought, oh, that must be the trade. So if we trade yesterday's high, low, close, then I want to prepare for price to come down and bounce that level and then, catch my trade. But that's not how it works, right? And that's not the idea here. It's not the goal. If you're going to trade a double bottom or even a double top, take it the other way around. You got to kind of understand the mindset behind the setup, what it's supposed to present as, how it looks, why it performs the way it does. So if we get price just coming over and hitting and bouncing on that level, I'm more apt to take a short. Because if you think about what I just drew, that's an inverse cup and handle before moving to the downside. A double bottom, on the other hand, is supposed to go lower than the previous low to be a bear trap and then to come back up. The tricky part comes from if we do get a breakdown below this previous low, how do we know it's a bear trap and not just a breakdown to the downside? Well, there's no perfect way to answer that, but it shouldn't expand too far to the downside before turning around and coming back up. That seems a bit arbitrary. How far is too far? So you can use that quant drawing tool, or if you're on a different platform, just use a Fibonacci. And I like the 111. So if we do get this double bottom and it breaks lower than the previous low, it really shouldn't expand farther than this 111. It should get tangled up there. It can wick through, even close below, but it shouldn't continue lower. Get tangled there, turn around, begin its way back up again. If we do continue through the 111 and we get all the way to the 1236, then I consider it just a straight up breakout, or in this case, a breakdown. And I would target the next level, which would be half of the range that we measured and then all of the range that we measured, with, of course, any other pivot that happens to get into the way. I mentioned yesterday that we got to the ADR really early, and that because we had got to the ADR early, that we could go to the other side because we had gotten there so quickly. We're at an ADR level this morning, so the same thing applies. Since we've already hit the ADR half on one side, we could very easily go hit the ADR half on the other side. So an upside push. At this point, the fact that we're fully below this ADR half and we're negotiating with this low without having broke through it yet, I'm kind of the mind that we are going to continue to the downside. But we don't have to guess or assume which way this is going to go. We can just wait for price to break it, take the trade, or wait for it to come back through that red line and take the trade the other direction. Because if we're going to go back up, we've got plenty of room, right? There's plenty of room back to the top up here. The half back is basically at the VWAP. So we'd get through the ADR half, get back to VWAP through the half back. Yesterday's close, this 0 gamma level, 10-day MA, just all the way up back through the pivots. Speaking of pivots, there's something called a pivot channel. So I'm going to just zoom in here a second. Put these candles out of the way. Here's the daily pivot point. That's a math calculation, high-low close divided by 3. Well, there's another set of numbers that you can add to this math formula, which will give you these 2 gold lines. Where we open in relation to this group of lines has a bias to it. It's a generic bias, but it's a good place to start. So if we opened above all of those, we would have a bullish mindset, a bullish bias. And if we open below them, then we have a bearish mindset and a bearish bias. We would want to seek out short opportunities. It's not telling us, okay, we opened below it, so short this thing. But it's saying we should find short opportunities and be cautious with long opportunities because we're underneath it. So at a glance, it just kind of gives you an idea of what's the market like today? Where did we open in relation to that pivot point? And of course, you can do that same thing. I'm looking at a daily one, but if we were on a weekly or a monthly, we could do the same thing. So here we can see the weekly. This line here. We opened right at that weekly pivot point earlier in the week, right? Yesterday. And we've drove away from it since then. So this is the range that we're dealing with. And this control candle from the 20th is still the one that we have to negotiate with. Sure, we're looking at yesterday's low, kind of, gauging things off of that really close candle because it's the closest one to us at the moment. But this one back from the 20th is still the candle in control. This double bottom has more weight to it than the one that we were referencing from yesterday's low to this morning's low. Ten-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We're passing through this area that we had discussed in the last few weeks as a possible shallow area because we had moved through it really fast before. Hi, kitty, kitty. The problem is after we had moved through it really fast the first time, we built structure through it on our way back out of it. We are still seeing violent moves through there, but it's catching along the way. Doesn't matter. It's still a very narrow range, 48.40 to 47.40. It's a 100-point range, 10 days. That's really compressed. It might not seem like it, 100 points. It sounds like a lot, but it's 100 points in 10 days. So this is still a lot of compression. And when we come out of this, we can expand greatly because of it. The longer we stay in a sideways range, the more energy we build up. And when we break out, we can spend that energy. We still don't have a classic shape, although if I was to, try to put something to it, it could possibly be a classic D. There's just not enough across the top to give us that. And the tail down at the low end isn't long enough to give us anything else. So it's still a muddy mess. We do have a shallow area directly underneath the point of control, so we could possibly begin to build out a P, capital B. But at this point, focusing on 47.43 would be the low end of this volume profile over the last 10 days. No VPOC to carry forward from yesterday, and the one that was here no longer applies. We took it out yesterday. We didn't even respond to it, right? We cut right through it like it wasn't even there. Price never reacted to it at all. The next one down is 4,700. Basically, I think the round number has more weight to it than the VPOC itself does. So we're going to focus on 4702.75. I wouldn't stress on that little bit. The round number is key. So here's the weekly expected move. Yesterday, we got kind of close to the low and managed to pull it back again. Today, we're taking another stab at it. 47.61 is the weekly expected move. And the thing is, we can break this low and expand below it, but we're supposed to close at the end of the week inside the range. So we can leave the range, but we're supposed to come back into it by the end of the week. If this wasn't the S&P, then the average should be 68 point blah, blah, blah. We just round up and say 70%. We should close inside this box on anything other than the S&P 7 out of 10 weeks, 70% of the time. But it is the S&P. And because of the liquidity and the accuracy of the expected move for the S&P, it's 8 out of 10. 80% of the time. So we can count back over the last 10 weeks and we can ask how many times on Friday did we end the week outside of this box? And if the answer is we've done it more than twice out of those 10 weeks, then we're failing to capture that 80%. This range is based on implied volatility volumes within the options chain. And those values are based on how trades are taking place in the options. So they're math based on traders' actions. But where those traders trade, whether they're in the front end of the pool, farther out in time, close to the money, out of the money, how they trade and where they trade affects this thing, this range here. It was set on Friday of last week, so anything that's happened this week doesn't affect it. It won't move again, just like last week's and all these other weeks. They're set now. They don't move. I bring that up because they're not arbitrary. I didn't decide I wanted these lines at a certain spot. Math says this is where they go, and that's where we put them. The math also says we should stay inside X amount of times, 8 out of 10, because it's the S&P. So when we start breaking that, it's a warning, let all of us know, hey, the market is getting violent enough that it's breaking its own measured moves. It's moving farther than it should, faster than it should, extending farther than it should. And usually it's a pretty good warning to bigger catalyst events, say 07, 08 crisis or even COVID, because we started to break out of the boxes more and more in the weeks coming up into COVID. It's the optionality that sets this range, and then it's traders that break us out of it as well. How many times in a row we stay inside the weekly range starts to set us up for a breakout as well. If we know that the average is 8 out of 10 and we've closed inside the range 3, 4, 5 times in a row, it comes down to, it's like we're almost due a breakdown just because we haven't broke down in a while or broke out. Either one, either direction. So we had 2 weeks in a row where we stayed inside the box by Friday. We're not exactly owed a breakout here, but we haven't had one in 2 weeks, and it wouldn't surprise if we get one. Just remember, we're more likely to close inside this range than we are outside of the range. So even if we do break down today, that's not any premise that we're going to continue to the downside. We're 2.5% above the 10-week, so we're continuing this glide back down towards zero. Remember that we're not owed a move back to zero. We can fade off of the highs, hold that fade, and then continue to run back up again. We've seen many examples in the past, right, where we got close, we didn't get down to zero, and we began our move back up. As a halfback measure, it's 4,500. It's a long ways off. Even if things were to just get really nasty out there, that would be a stretch to get to this level within, a few weeks. But it would have to be really nasty for even that to happen. What's more likely is we just move a measurement of this very large candle back here from the 20th. Half of that, or even 100% of that, something around 4,650, 4,600. If things were to get bad out there. And I don't see it at this point. It's not that bad. These are the top 10 names at the close yesterday for the S&P 500. It's not necessarily the names themselves that I wanted to point out. It was their industry. Not tech. These were the ones that were down the most yesterday in the S&P 500. And again, it's the industry to focus on: semiconductors, hotels, resorts, cruise lines. We can see that here this morning. The top 3 charts up here are our risk on markets. The bottom 3 are risk off. The 3 in the middle are midline. But also think of it like economic backdrop. The ones down on the bottom, these are defensive names in an economy where, maybe jobs are getting a little scarce, or companies are cutting back due to a lack of orders for production, things like that. In that environment, what's going to do better? Utilities, healthcare, staples, because people are still going to eat. They're still going to need medical care. They're still going to need heat in their house, air conditioning. So we saw a little bit of a rotational change. Now we can get 1 or 2 days where we just get a minor rotational change, and then we come right back around and we continue to do what we had been doing. We're getting close to a new earnings cycle. We could start to see a run up in financials. And it wouldn't surprise this morning if we get a little bit of reciprocation from the things that fell starting to pop up, and the things that had run hard yesterday maybe starting to pull back a little bit. So things that are down this morning, of course, Bitcoin with the news, tech, gold, semiconductors, bonds, China through the emerging markets, airlines. It almost might have been easier just to name what's up this morning. What's up? Now it's a little odd here. This Bitcoin says we're up. That other one says we're down. Usually what happens with that is that it'll read, say, after hours from the previous day, but it's not reading the pre-market. So we'll dig into Bitcoin a little bit and see which one of these ETFs are not accurate. Nat gas. And I don't know if this is reading today's or not. So let's go take a look. Sure enough, it is. And real estate. Although that's not really got much flows yet. All right, so we got some commodities this morning through this agricultural ETF, DBA. Pot stocks through MSOS. Crude. Nat gas. Lots of different energy today between crude, nat gas, and just XLE, a vague energy. But XLE isn't up enough. Remember, our benchmark is 0.5%. So with this Bitcoin, we really haven't left the zone yet. We're still threatening to leave the zone, but it's holding on at the moment. I haven't had a chance yet to go check that news out. And then the precious metals is going to be a direct link with whatever's going on with US dollar Japan. And as you can see, since the open last night, this thing has been just 45-degree angle to the upside. We are getting right through this resistance. So let's take it into a higher time frame here. All right, well, I'd say that's a fairly easy example of a turnaround. Now we've been through this 10 before. We got through there back here. And it wasn't able to keep it. It just sold right back off again. And that was a really nice looking cup. It never made it back into this zone. So we've got the same setup this morning. We're through the 10. I'd say the only difference is back here, when it broke through the 10, each one of these 10 MAs, it was still going to the downside. We still had a descending 10 MA. But over here, we've got an ascending 10 MA. And we've got price broke through it instead of the other way around. So it's a start. Both of these had a higher low. Now that we're through 142.80, it really needs to keep it. I guess we could wick back down below it, but really needs to keep that close above the 10. If we can keep the close above the 10, we'll start working our way back through these other levels. With US dollar Japan headed to the upside, we're going to expect gold and silver to weaken up. Not necessarily crash and burn, but I wouldn't try to take longs in it. And unless they present with a good trade short, I wouldn't necessarily try to short them yet. Bearish neutral, something like call credit spreads. Not necessarily at the money, though. I'd want to see something out of gold or silver first before I try to short them. Just having Japan down isn't enough, right? That alone wouldn't be enough to do it. We did get a breakout on the dollar. So we got some resistance coming up, 102.65-ish. We are at the halfback. So if it's going to reject, it's going to be in this zone. If it's going to reject. Now, this has been a reasonably decent turnaround, not a V bottom per se, but the 10 MA is now ascending. We've crossed through it nicely, and we have a 310 cross, which is the surge signal, right? So price above both MAs, 3 above the 10, having just crossed from yesterday to today. That's a surge setup. It has to reject here and begin working its way back down. It has to be a halfback failure. Otherwise, we're going to get a halfback breakthrough and we'll start to target the quarters on the upside. So the next target would be this 25% mark, 103.35. If we can get through that, then back to the high of this, and we'll start to look for a handle on this cup. Because at that point, we would have a cup and handle. The bond volatility picked up. That's from the MOVE index, MOVE. Unfortunately, the MOVE index is something that is recorded once a day. So it doesn't have, like a daily chart, an hourly chart, 15-minute chart. This is the MOVE index. No, it's not. Hold up. This is the MOVE index. So bond volatility, you can see how it really picked up yesterday. This is very likely not going to be very good for the S&P, the NASDAQ. If you think about how the S&P last year fell as we got into March and the banks, there was that little bit of a bank crisis last year. We can see from February into March, the MOVE index, the bond volatility really spiked up. Well, down here in purple, I have the S&P, the SPX. And what we can see is the SPX fell from that peak in February through March into a trough before the Fed came in and kind of played save a hoe with the banks. Well, when we started coming back up, the bond volatility started coming back down again. So this spike here in the bonds is worth paying attention to. It's not as bad as these spikes back here, but it should be something we need to stay aware of, right? Because we could start to have more reasons for a sell-off or more fuel to the fire, right? Now, look, we had, some pretty decent pops back here too, and it's not like it turned into some, big sell-off in the S&P. So one day isn't really enough. It's just, I'm putting it on your radar. So we got bonds at this low. It did go lower than the previous low, which sets us up like we're going to have a double bottom. But after it gives us that lower low, it's supposed to get up and do the thing. It's not supposed to sit around down there and chill. So it starts to negate the idea that we're actually going to get a double bottom. Now, having said that, we are set up for a really nice trend line breakover. I wouldn't worry about trying to draw it perfectly. Just the idea that this is a nice setup for a trend line breakover. We have a candle of control. All we got to do is get out of that. We're underneath the halfback, and you can see how they've been defending it. Every time we try to get above it, they just sell it right back down again. Until that liquidity's gone, we're not going to get through that zone. And if they give up trying to even run it up there, we're going to break down to the downside, and then things are really going to start to get ugly. Call it 122. It might not seem like a lot because we're looking at maybe, a 1.5, but a 1.5 in the bonds is a big deal. Yeah, it comes out same thing either way. If we measure it from this last leg, the halfback is 122 that direction as well. So a breakdown would get us to 122, and a continued fade would get us to 122. It'd still be asking the same question: is this just a pullback, or are we starting to roll over? Because this is a really nice trend, and we had a nice pullback, and then more of the trend, and now a pullback. You can see the last time we got into the pullback, we were just tangling up around the 10. Well, we're through it. It's not too big of a deal. We can cut through the 10, get a deeper pullback to something like the 20, but that really needs to hold right at by the 20. Don't really want to be cutting down deeper than that. And the 10-year is inside day breakout already. 10 years been headed to the downside for a while. It's going to be a bit of a struggle to negotiate with. You can run it through the TNX. So this is tradable. The bonds are tradable through TLT. So, it's not just like you got to have a futures account. You can run these through options and the shares on the ETF. I'd say 4% is a level of concern. It's not only a round number, but a psychological level of interest. So we want to see the 10 continue to close below that 4. We can wick above. It's not going to be too big of a deal, but we need to close below it, and especially close below it on the week. I'm on a daily chart, but a weekly close is going to be even more significant. And this kind of a little extended morning briefing is all based on the kind of bigger picture of the market and what are we going to do with it? What's our expectations with this pullback? So far, we don't have enough information to say that we should short the market and pile in heavy. We're still trying to negotiate with this topping pattern and whether or not it's going to resolve into something else or not. If we keep this under 4%, I don't think it's going to get worse in the S&P. Sure, we can get a little lower, but I'm talking about like an extended leg down. Well, out of the fangs, Tesla broke below yesterday's low. It's recovered already, but it did already make that breakdown. AMD's still expanding to the downside quite a bit. And I mean, it's got some room to move. Look at where it stopped going to the upside. I measured this draw and plotted 50% up. And it wasn't to the penny, but that's where it stopped moving up. I love this stuff. So now we're looking at a potential Busby. We had a resistance, we broke through it. Now we're likely to come back and test that old resistance as a new support. That is literally the definition of what a Busby is. SMH isn't looking too much better on the daily, but on the intraday this morning, it's not down as much as AMD. And AMD and NVIDIA look a lot alike on the intraday. I don't think it looks so bad on the daily, mainly because NVIDIA didn't have that really nice breakout that AMD did. Still, the range is clear. We got to get out of the box. And no matter where you want to set your low at, the high, there's really not much of a discussion about where the high goes, right? It's that 500 level. So what I would focus on with NVIDIA is this last draw. $478. We can wick through it like we did yesterday, but if we continue to the downside, then we want to target that next quarter, 464. and then 450. If we bounce here and begin working our way back up, then we can target the quarter to the upside, because this will be a half back bounce, and take, say, 493, 494. All it would take is getting back above that half back break. Which right now, that's not on the table. All right, Jets broke down below this trend line. It's been a nice move in transportation, but this pullback is a little deeper than it should be. We can try to 786 on this thing, but I really think it went too low. No, we're wrong. I'm wrong. It's right there. So if we can hold this 786, get back above it, then this is just a pullback. We could digest that, and that would be our channel. 1840 to 1940, that $1 channel. So we would expect Jets, just like back here, built that channel, maybe digest inside it a little bit, leg up to the next zone, built the channel, leg up to the next zone. If we break that 1840 solidly on the week, say get a weekly close below that level, then we can target 17 and begin working our way down. It's the half back that we would focus on. Keep your eye on energy, right? Crude, fuel, especially jet fuel. Those costs are going to be the deciding factor on this, very likely. US dollar Japan accounts for the gold, silver, semiconductors still getting punished. I wouldn't be surprised if we get that run into earnings on finance. Look at yesterday on the XLF compared and compare it to how the S&P closed yesterday. So we're kind of at a key level, but we've been topped out here and it continues to test against these highs. It looks a lot better than, say, the SPX. Take it a little deeper, put it into banks. Maybe doesn't look so good as XLF does. $36.50 to 37. It's a 50-cent zone. It's not too bad. If we can keep that, then we can work our way back up into 40 and then 41. So candle of control is December 11. And 38.5 is the issue to the upside. Now this is a weekly chart. So we're focused on an inside week breakout. Just one level at a time. Just remember, we got banks coming up, right? They're going to lead the earnings. They always do. They kick it off starting next week on the 12th. So if we're going to get that run up, it kind of needs to start. And this was a nice pause to kind of give it a rest after this really decent run. So it kind of makes sense. I think it's worth keeping an eye on. And banks are a good one to trade, you know, for a day trade and for a swing. There's some cheap banks out there. You know what I mean? Like Wells Fargo, places like the JP Morgan. So I got everybody be careful, be safe. I will see you all tomorrow.